Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in and take a look, see what is going on today. If you want to follow me at _finance, and if you want to join our community, we do have a special going on. Special is the coupon code that works on both the monthly and yearly memberships. Go to finding-value.com and sign up using that code. All right, starting with CEO, it says the majors are sitting on mountains of cash. He's talking about the gold major mining companies. And Jacques Bonneau says junior mining boom is coming quick. They'll have to invest in the juniors. We're just starting to see that, and we'll see more of it this year and next year. With gold above $3,000 an ounce, capital is about to flow fast into those juniors. And, I would agree with him. I don't agree just because I like the mining companies at the moment. I agree because I see it in the charts. I see a lot of good opportunities in silver junior mining companies. Some of the gold juniors haven't run yet either. They're still squeezing up into corners of falling wedges for some of the companies. Some of the silver junior companies have already come off their bottoms a good few hundreds of percents. Some of them, 2, 3, 400% off their absolute bottoms. But I still think there's a huge opportunity there. And I would agree with them, not because it fits my opinion, it fits what the charts are showing me in the markets. Scroll down, rumor Powell is resigning on Monday. Fasten your seatbelts. This printing will dwarf everything else and send hard assets sky high. Now, that's obviously a rumor. I have no idea if Powell's going to resign on Monday or not. You guys are watching this Monday. I'm doing this Sunday, kind of afternoon Sunday. But if someone else does get put into power, and if they lower interest rates and start to print, then yes, we are going to have a lot of inflation and a lower dollar. What that's going to do is it's going to spark monetary bank lending. Right now, Powell's been slowing down bank lending, and fiscal spending's been running the show. But if you lower rates, you're going to kick back up monetary bank lending, which means more money is going to come into the system. You'll probably see strength in the housing market reestablish itself. That's one area that I'd be watching. And then I'd look at home builders too. So if someone does come in there and if they print money and do QE or do whatever the heck they're going to do, those are the sectors I would be watching for a quick return to more of monetary bank lending. Here's Josiah. He says, stacking gold since 2002, he's got a total of 230 ounces. My granddad left me 1 kilogram in his will. I've been flipping Fed notes into gold since. The Johnson & Matthey kilogram I bought in 2003 for 11,670 is worth 106,242 today. Look at that. Oh, look at all that. Pretty nice stack, I would say. I was looking at this. I was like, wow, 200 about 230 ounces. That's a pretty good stack. If you swap that into silver, you'd have a small room full of silver. I mean, it is silver is ridiculous. How much room it takes up. But yeah, that's a pretty good stack there. That looks pretty nice. I was drawn in by the picture. Metals weekly price and performance here. So molybdenum taking the gold medal this week, or I should say the molybdenum metal. It is up 3%. And we had a lot that was down last week in terms of metals. Lithium, tin, palladium, and copper and platinum didn't fare that well, all down about 3% or more. And then we had a couple of neutral stuff. Antimony, uranium, manganese, and aluminum were they're kind of flat this week. Alexander Stahl says, under normal circumstances, higher yields are a sign of the U.S. economy performing strongly. That's attractive for capital inflows into the United States. But But if the yields are going up because US debt is more risky because of fiscal concerns and policy uncertainty, at the same time, the dollar can weaken. So what we saw historically is a relationship between dollar and US yields moving in tandem. So we'd see the dollar and yields go up together and they would go down together. What we have recently seen is a separation between the dollar DXY going down and the 10-year yield going up. And I think the only thing that we can kind of make sense of it is that people don't want to hold dollars and they don't want to hold bonds. And this relationship could have broken apart here at Liberation Day, where everything broke apart. That correlation or relationship. Another relationship that you would see is that the dollar would go down, interest rates would go down, and gold price would go up. But gold is following yields higher. That's another sign that people are running into gold as a safe haven asset versus dollars and bonds. Just an FYI there. Paul Pa says, you only get a few opportunities and you have to grab them aggressively when they come, because even in the most favored life, they're really rare, says Charlie Munger. You only get a few opportunities. You have to grab them aggressively. Now, here's my thing. How can you identify a great opportunity when it arises, and how do you grab it? In 2020, there was a great opportunity in oil and precious metals in March and April of 2020. I couldn't sleep at night. I was just watching. I was like, I don't understand how these oil companies are priced so cheaply. Yeah, some of them had some debt. I didn't think some of them were going to go bankrupt. There were a few that did go bankrupt, though. But I was just looking at it. I'm like, man, they're trading at pennies on the dollar. I hate to say it, but we've got the same situation right now in oil. When I go and I look at some of the companies, I just look at them like they're trading at pennies on the dollar. And we've got an oil to gold ratio above 50. That's the same situation that we were in 2020. The same exact ratio of gold to oil. And some of the valuation metrics that I look at are very similar to 2020 timeframe. Maybe not March or April, but definitely September, October of 2020. And that's where I made a ton of money. Now, I don't know if some of the companies are not as cheap in certain sectors, and other companies are incredibly cheap. So it does depend on the sector, and it does depend on the company that you're looking for. In Gold We Trust, it says, we're witnessing capital outflows from once immensely popular and widely held sector into performance of gold, an asset that has lingered in the shadows for nearly a decade. The big long is not merely beginning, it is awakening. And he's talking about gold and silver outperforming all these different other financial assets. So this is the S&P 500, which is a representation of financial assets, versus gold, silver, Huey, and BCOM. And you notice they're all turning lower just recently. Is this the beginning of a shift where gold and all of these other gold, silver, Huey, and we'll call that Bloomberg Commodity Index all start to outperform financial assets? Very well could be. Now, could we bounce around a little bit more before heading lower? It's always possible. It seems like everybody wants opinions. They want to know the timing of everything. The problem is nobody knows the timing. What we do know is the valuations. And I know people are trying to time the market. It's very difficult to do that. But what you can do is you look for valuations, and that's basically what you're timing. You're timing the market by using the valuations. No one knows the exact time, like looking at a watch and saying it's going to go at 3 p.m. on a Tuesday. We're not taking airplane flights here where they run on schedule. This is all based off of the perceptions and the money flowing into the sectors of the collective investors out in the world. And what I'll say is this: money starts to flow away from underperforming assets and towards overperforming assets. And that's just the FOMO, the fear of missing out, kicking in. And that's what causes or gets people to move money. It's seeing losses in your account, and then they see something else outperforming it, and then they go and swap it over to that outperformance. Another one from the Gold We Trust says, if you thought silver was undervalued by looking at its nominal price, what do you make of its consumer price index adjusted one? What will be the catalyst for the much awaited silver rally? I think the catalyst is already lit. It's just a matter of time before the money flows as people again feel losses from certain sectors and then will flow towards outperforming sectors. Gold and silver outperform when interest rates go up, and I think we're in an interest rate increasing environment. When interest rates reach about 4.5%, 5%, that's when people start to take notice. Money starts to flow out of financial assets, and it will start to flow more towards gold, silver, and other commodities and hard assets. That's the cycle. And then you just have to wait for it. This looks really good. If you can draw a line through here, in fact, we can do it together. Let's do this. I'll just pull up paint real quick, do a quick line because I see you can see this on the right-hand side there. Let me move it. You can see it on the right-hand side over here. And what I see just looking at it, we'll just do a line here. Let's do that again. I did the line in white and you can't see it. Well, come on. Kidding me? There we go. There we go. There we go. Why is it not showing up in black? That is very interesting. Anyway, I will just draw it in as best as I can, and I will. There's the line going through there. It's already broken out to the upside, and it looks good to go higher. But that's the silver divided by consumer price index and that downtrend line that I see breaking. Looks really good. Jordan says correlation does not equal causation. Gold divided by the consumer price index is already broken out to new all-time highs. Silver would have to rise 50% to get there. Silver is a leverage play on gold. Gold stocks too. Gold versus SPX, CPI, DRB, etc. correlates with the leveraged plays. But gold divided by the consumer price index only directly influences gold stocks because it closely reflects minor margins and cash flows. This same chart was floating around months ago. Silver has followed gold prices adjusted for inflation for many decades in history. And this is silver trying to do a catch-up move to gold divided by the consumer price index. So it'll move. It's coming. Don't get too impatient. And again, money gets transferred from the impatient to the patient. So be a patient investor. Wait for this to all play out. It's coming. Here's the joys of compounding. Delayed gratification, doing what is hard now rather than doing what is easy, builds up the muscle of discipline, strengthens one's skills and capabilities, and compounds into a much greater level of success and satisfaction than taking the easier path. I don't know what this exactly means. Some people, they want to have instant gratification. I guess they want to buy a bunch of crap. I'm pretty much the opposite. I find joy in investing, saving, and then not really buying a bunch of crap. And as you get older, it's almost like you don't want any crap. You just, like, crap kind of owns you. It takes up your time. Like, The more cars you own, the more oil changes you have to do, the more maintenance, the more wheel bearing changes, all that stuff. The more crap you have, the more stuff you have to worry about in terms of picking it up, vacuuming around it, whatever it is. As you get older, it's like, how about I just do a minimal, the minimal amount where you have to worry about less and just live more, so to speak, and not be a slave to the things that you own. So, yeah, that's kind of the way that I view it. And that's, you could view kind of everything like that. Um, but yeah, that's kind of as I go through. So, delayed gratification depends how you define gratification. What I like doing is I try to get as much money invested as possible so that I can get more money in the future. But at some point, you have to reverse that. It's hard being a saver and turning into a spender. That is definitely something that I'm going to have to work on out in the future. Josh Speed says, bro, check out this insane chart, particularly the wages in gold terms. This has to be the end game. Well, I've always known this, but look at 1913. If you price the average annual income in gold or silver, in gold, it was 38.7 ounces of gold in 1913. We went all the way up to 1971, where your income could buy 248 ounces of gold. That's also, I think they were cheating the system. They were printing too much money for how much gold that we had. So I do think they were cheating the system. Then in 2025, gold caught up, and your average income in terms of gold ounces is only 19. So we're far worse off in terms of how much ounces of gold you earn per year versus 1913 when the Federal Reserve was created, and 1971 when we went off the gold standard. And you also have your income in silver down here, 800 ounces, 6,774, and 1,920 is today for silver. Unpopular opinion, it really doesn't matter what we do in the West against climate change. As long as Asia builds almost 1,000 new coal power plants, prove me wrong. Well, it's not about the West. We outsourced all our stuff to China. So a lot of people are like, oh my God, they're so dirty over there. Well, we outsourced all the dirty work that we used to do here and in Europe. So they're ramping energy as fast as they can of all. They're putting in solar, they're putting in nuclear, they're putting in coal, they're putting in natural gas, they're probably burning oil, they're burning everything. They're the ones building all the stuff. Takes energy. If we were to bring back this stuff to America, our grid, our steel and buildings and electricity demand would skyrocket if we brought it all back to America. It would skyrocket. Market Sniper, it says the financial collapse is near. You heard Jamie Dimon warn you about the bond market, that it will break soon. U.S. is desperate for a hot war with China and more on debt. Military spending. War is their masking agent for financial collapse. Pentagon chief says ready to fight and win against China. Urges allies to boost defense spending. Well, yeah, they're just going to blame it on something. It's already screwed. So they need to get into a war and say, look at this war did this. This is what we're spending on. It was the cause of this war. It's just a scapegoat. Another one from Grady has a red slingshot move, gold does, in play that now does look parabolic. Posted this setup first time at Blue Breakout. Few believed. Still on track for the 4-year parabolic base that is ripping. Gold still in action. Colin says, crazy how homeowners are sitting on the largest amount of equity in history and are barely touching it. Your typical homeowner this cycle just isn't levered like they used to be. As such, they've got a lot of room to absorb a home price decline and still sell for a profit. Well, yeah, they can't take the equity out of the house because they're not going to refinance at higher rates. So it's all stuck in their house, which is fine. That's great. The housing market's never been as robust as it has been. So where's this big crash going to come from? Where are the forced sellers? If no one is really underwater, I'm sure there are some, but not nearly as many as the mid 2000s. So if hardly anyone's underwater, we've got all this equity tied up in the house. Where's the forced selling going to come from? A few late buyers the past few years? And remember, home sales have been down quite a bit. So I don't think there's a ton of people underwater. Yeah, there's some, but I don't think there's a ton. HFI Research says the most interesting thing about the natural gas production data is that associated gas production remains near all-time highs. The discipline is coming mostly from Haynesville producers. U.S. crude oil production has already weakened, implying another bump higher in GOR. I don't know what GOR is. I'm trying to think of it off the top of my head. Whatever it is. But this is U.S. crude oil production. Natural gas is the dotted line. And this has to go up, guys. We've got produced a lot of natural gas for all of the LNG terminals that are coming. So we kind of have to keep going higher and higher and higher. We got to punch it. We've got a lot of capacity coming on in late 2025. But here it is. We're rolling over for oil. Brick by Brick says, I already went over that one. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use special as the coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.